Hello again, accountants. Now we are looking at Unit 9, Section 3, the assignment Plant, Assets, and Depreciation. So in this section, what we're talking about is how the value of our plant assets can depreciate. So the difference between a plant asset is an item that we use to run our business. Okay, and then current assets are the items that we purchase for resale. So plant assets help us run our business. Current assets are what our business sells. So we would expect to get rid of those within a year. Plant assets we hope to have around for several years. So as we hold on to an asset for several years, it can depreciate or lose some of its value. For instance, I'm sure a lot of you are familiar with cars and losing their value as the years go by and the mileage goes up. So we have to account for that depreciation in our businesses. So how we do that is we have a depreciation expense account, which is when you see expense, that should tell you an expense account right away, whether or not I'm increasing or decreasing on the debit and credit side. And excuse me. And then we also have what's called an accumulated depreciation account for stores equipment. Okay, and if I look at my text over here, if I can get the right window open, when I look up the accumulated depreciation account, and I am on page 17 of section 3 in Unit 9, we find that the accumulated depreciation account is a contra asset account. So it is a contra account to whatever asset it is working with. So the related account is the plant asset account. So you'll see here that so when we talked about contra accounts, they're usually set up the opposite of what that asset account is. So an asset account would be increase on the debit, decrease on the credit, where this contra account, accumulated depreciation, is set up decrease on the debit, increase on the credit. Okay, so that's how we're going to set up this account. Oops, just wanting to do an automatic formula there. So we're going to decrease on our debit side, increase on our credit side. And you should have had time to think about this expense account. We're going to increase on our debit side and decrease on our credit side. Okay, so we have our account set up. Now let's look at the situation that we're working with here. So this part 1 tells us that our store equipment, which we purchased in January of 2002 at a cost of $14,000 and plus $1,000 for installation, the depreciation is written off at 10% on the original cost every year. So if we were to, well, then it says that they close their books on December 31st every year. So we're just going to assume that we're looking at 1 year in this part 1, and part 2 we actually look at several years, but in this one we're going to look at just 1 year. So in this situation we want to look at the excuse me, the total cost of the van. So, or not the van, the store equipment. So it cost us $14,000 plus $1,000 for installation. So when we look at this 10% off for depreciation, we're going to look at the total price that it cost us to buy and install this equipment. So we're going to take that 10% times 15,000 here in order to find how much we're depreciating. So, and in these accounts we just want to record the amount of depreciation. And what I like to do is, I'm not always the best at math off the top of my head, so I like to use these the formulas in Excel to go ahead and calculate this. So I'm going to put 15,000 here, and I'm doing percentage here of 10%, and I want to find out what 15,000 times 10% gives me $1,500. So then I'm going to use that amount, my depreciation, so that tells me that this store equipment, at the end of 1 year, it's going to depreciate by $1,500, $1,500. So I went from having $15,000 worth of equipment down to $13,500. But we're only recording the actual depreciation amount in these T accounts. So our depreciation expense, the expense is going up, so we're going to record that in our debit column, and our accumulated depreciation is also going up. It's the contra account to our supplies, so we record that here. And that's all there is to it, part 1, because it didn't specify how many years we should be looking at, so we only looked at 1 year. And then in part 2, you can see right off the bat we're looking at several years. So let's see what our situation tells us. Again, we are working with the same accounts, depreciation expense and accumulated depreciation. Only this time we're looking at office equipment. Notice that there is a separate depreciation expense account for each asset that we're working with here. Okay, and accumulated depreciation. So that in part 1 we're looking at office or supplies. Now we're looking at office equipment. So our situation tells us, let me zoom in a little bit for you. The company acquired office equipment on January 1st at a cost of $40,000 plus $1,000 on installation. The company writes off depreciation at 10%, again, using the declining balance method, also known as the reducing balance method. The accounting books are closed on December 31st each year. So this time it wants us to show the depreciation account over 3 years. So to do that, they told us to use the declining balance method. So there are several different methods that you should have read about in your text. And in this one, we're using the declining balance method. So that tells us we want to look at what our annual depreciation is. It's going to equal our depreciation rate times the value at the beginning of that year. So after the first year, we know we're going to lose a certain amount of value. So then we subtract that and then use that new value to take times 10% again, which I'll show you here. So again, we're working with this expense account. Putting the right key, oh my goodness. Increase, there we go. Decrease. And our accumulated one, our contra account here. Alright, so let's find out what we're doing, what we're working with the first year. And down here I told you to show your work, so I'd like you to at least show me what you're doing to get the amounts that you're coming up with. So in this first one, in year 1, we're looking at $41,000. Again, we look at the total cost of purchase and installation. So we're working with $41,000. And we're going to take that times, again, it wants us to use 10%. So I'm going to do a little multiplication here. Gives me $4,100. So that's year 1. In the first year, we're losing $4,100 in value in this office equipment. So that increases my expense account. It's also going to increase my accumulated depreciation account. All right, then to find out year 2. So now I need to use the beginning balance that I have for year 2. Which, how do I figure that out? I'm going to then subtract. I like to use these formulas, like I said, so that I know that I'm not really messing my math up. So I'm going to subtract what depreciated that year from what the value was at the beginning of the year. So here's my original value. I'm going to subtract how much it depreciated. So then I know that the value I'm starting with in 2002 is $36,900. So now, because this declining balance method tells me I need to take the value at the book value at the beginning of each year. So now I need to take this value times my 10% to determine how much depreciation I'm going to see this year. So again, we take our 36,900 and 10%. Now we see it's going to decrease 3,690 this year. So for year 2, we only need to record it in our accumulated depreciation account. Because we're just trying to look ahead to see what the value is going to be in the next 3 years. Okay, so it's only an expense if we're paying it that year. Does that make sense, I hope? So when the year 2002 comes around, that's when we would record it in our expense account. But for right now, we're just looking at our accumulated depreciation and trying to get a feel for the value of our office equipment after a few years. So for this year 2, we only have to record it in our accumulated depreciation. Then we need to find out what that amount's going to be again. Oops. So now we're working with 33,210. Copy that down. I'm going to take this times this. So then I'm going to lose another $3,321. So after 3 years, I'm losing this amount of money each year. So now I want to see how much, after 3 years, how much total that I've lost in that 3 years from my $41,000 investment into office equipment. So I want to just add these amounts together to find out what my total is. So in 3 years, I'm going to be losing $11,111 from this $41,000 amount. Okay, so that's how we complete this depreciation, accounting for our depreciation. So if you have any more questions, make sure you're showing your work so that I know you're coming up with the right amounts and how you're getting there, because I think there is another a problem like this on our exam. So I want to make sure that you know how we're getting these amounts. So show me your work. All right, if you have any other questions, let me know.